Okay, so a lot of you guys have been asking me to make a YouTube video on how I identify my daily bias, how I identify my intraday bias, how I identify bias before taking trades, etc. So in this video, I'm going to be giving you a step-by-step, simple, easy framework which you can use to identify your bias, and by the end of it, you'll be able to identify your daily bias in just a few simple steps. So in this example over here, we can see price actually expanded to the upside during New York session, the AM session, and I'm going to show you how you can anticipate this and predict this before it occurred. So let's rewind to 9 AM Eastern Standard Time, and the easiest way I found to identify bias is to stack arguments in your favor versus against your favor. So what do I mean by that? So if you drop down to the 1 hour, at this point, right? So this is previous day low. So what we can see is price has swept previous day low in the form of sell side liquidity. Also, we tapped into this daily bullish fair value gap. So now there are two arguments for why price should be bullish in this scenario. There are two reasons why price should move towards the upside. First, we retraced into this daily fair value gap. We swept previous day low and we rejected from it and started accepting back into the range. And third, on this day, it is a Thursday. So there is a potential for a Thursday reversal in this case after sweeping Wednesday's low. Another reason you can also look at is also we had SMT with ES. So you can see with ES over here, ES had swept this low while NQ failed to sweep this low. So we formed an SMT with ES. So now there are three reasons why price should be bullish. Four reasons if you include the Thursday reversal. There we go. So we have three reasons to be bullish over here. And, including the Thursday reversal, there are four reasons. And then if you look at the reason to be bearish, there actually isn't many reasons other than the fact that once we tap into this 1 hour fair value gap, we might reject from it. But until then, there's absolutely no reason for price to continue moving to the downside. Like, if anything, price is going to come up, sweep this level of liquidity, tap into this 1 hour fair value gap, and then reverse to the downside. So at least we know price has to move up higher first. And if you drop down to the 15 minute, you can see price actually made a confirmation by inversing this 15-minute fair value gap. So by forming an inversion fair value gap, we actually gave an additional confirmation that we are looking to move higher. So the easiest way you could have taken a trade from this is you notice first we have this level of buy side liquidity, and most importantly we also have this level of buy side. So you can see this candle high. Obviously this is also a form of buy side, and it also marks the start of this 15-minute fair value gap. So that will be a really key level for you to target. It is also within premium of the dealing range. So if you mark out the Fibonacci tool from the swing high to the swing low, above the 0.5 level is in premium. So that is an easy place for you to target, a simple, easy way for you to target. And if you drop down to say the 3-minute, and let's forward price, we only want to trade after 9:30. So let's mark it there. That is 9:30. So let's forward. And over here we can see we actually had a CISD right over there. And over here, after price forms to CISD, we can go long, stop loss below the swing low, and take profit at the 15-minute fair value gap. So just like that, you can see, boom, price hits a take profit, easy 2.15 risk to reward. And by the way, this is not hindsight. I actually took this trade live on stream yesterday, and I'll post a screenshot right on the screen. I made about $4,500 profit on this single trade. And again, it's extremely simple, extremely easy to follow. You just go from the higher time frames down to the lower time frames. You look for why should price be bearish versus why should price be bullish, right? You just look for different reasons, and there are certain days where you just look at it and there are so many reasons to be bullish and there is no reason to be bearish. Everything points towards price moving towards the upside. And by the way, if you like these types of videos, click the subscribe button down below. It lets me know which types of videos you like and which types of videos you find helpful. And another easy way to demonstrate this is to look at price in two different stages. So if you look at the two stages of price, price delivery. So you can look at it as delivering from and delivering to. So what do I mean by that? So let's say price is moving lower, right? And let's say we have this weekly fair value gap. And then price starts to reverse from here. Well, this is what you call price is delivering from the weekly fair value gap, because we came from the weekly fair value gap and we're delivering from it, right? And the second part is delivering to. So also very important, let's say we had equal highs over here, and then price is reversing towards the upside. Then we know price is actually delivering towards the equal highs. So we're delivering to the equal highs. So first thing we want to know is where we are delivering from, and second thing we want to know is where we are delivering to. So in this case, we are delivering from the weekly fair value gap, and let's say we had equal highs above here. Right, let's say this was equal highs. So we can say we're delivering from the weekly fair value gap up towards the equal highs. So we know where we're from, where we're going towards. And by the way, if you're finding this really simple to understand, or if you need a bit more help in understanding these concepts, click the first link in the description and join me in my private group where I'll coach you and mentor you one-to-one to help you succeed as a trader. So back to my example over here, you are delivering from sweeping the previous day low, we're delivering from this bullish SMT, from the daily fair value gap, from the 15-minute inversion, and this is also a balanced price range over here. So when an inversion fair value gap overlaps with a regular fair value gap, this is a balanced price range, a BPR. So we're delivering from the BPR as well. And also the confirmation of all of this is the 3-minute CISD. So once you have all of your higher time frames and your confluences aligned, the actual entry model here doesn't actually matter. Like you could have entered from any entry model from here. I entered based on the CISD because that's my favorite type of entry model, but you could have entered from this inversion fair value gap, for example. This is an inversion fair value gap. Easily could have entered from here. Yeah, once price closed above, enter into that trade, stop loss below the swing low, target the 15-minute fair value gap. Beautiful trade. Right, stop loss below the order block, target 15-minute fair value gap, 1.76 risk to reward. So there are many different ways you can enter. You could have even entered from the breaker block. This is a beautiful breaker block over here actually. So if you target over here, let's say expand it, boom. Once price closed above the breaker block, you could have entered into a position, stop loss below the breaker block, take profit at the 15-minute fair value gap. There you go. Easy, simple, and 1 to 2 risk to reward. So the actual entry mechanism, the entry model doesn't actually matter. Once you have the higher time frames aligned and you know where price is delivering from and delivering towards, then you have everything you need. That's all you need. So hopefully this video helps you. And if you want to learn the easiest type of market profile to trade, or the trading model which you want to trade, the easiest one to trade, the easiest one to find the buyers, find your entry, find a target, click the video on screen right now to learn about the London reversal. This is one of my most favorite models, one of the easiest models to trade. Click the video on screen right now and I'll see you there.